everyone. Welcome to the webinar this morning. This is actually the third in a new series of webinars we've had exploring issues that affect businesses, and we're happy that you joined us today. My name's Amy Jack, and I'm a partner at Safri. I'm joined by two of my colleagues, Nick Hart and Owen Hackling, both from our VAT team. Nick and Owen are going to walk you through some fundamentals of recovering VAT, some pitfalls to be aware of, and some practical tips to help maximise VAT recovery. The content isn't specific to any one sector or one type of VAT taxpayer, so it should be of interest and value to all of you, we hope. Just before I hand over, I do have a couple of housekeeping points to run through. The webinar is being recorded. It will be available on our website and kept for up to a year. But just to reassure you that no attendees can be seen or heard on the recordings, we would love you to submit questions, and we're saving time at the end for these. If you do have questions, then you should find a Q&A box at the bottom of your screen, so pop all your questions in there. Again, these won't be visible on the recording or to other attendees on the webinar today. And after the webinar, you'll all receive an email with a link to the recording if you want to refer back to it. So that's it from me, and I will hand you over to Nick and Owen.
Thank you, Amy, and welcome everyone. Good morning. Thank you for joining the session with us this morning. As you'll already know, the focus today is going to be on VAT recovery and mastering and maximising your VAT recovery position. This is an area that affects pretty much every VAT registered business, I'd say. And if you're here this morning joining us, it's likely that your business or one that you're involved in or that you advise incurs VAT to some extent on goods and services it purchases as part of the business's day-to-day operations. So for a VAT registered business, the VAT incurred on business-related costs typically doesn't usually represent a true cost, provided that the business is entitled to recover that VAT, and that recovery is supported by the correct documentation and sufficient supporting evidence. So with that being the case, understanding what VAT you are entitled to recover, also what you're not entitled to recover, and what evidence you need to support that position is really important for accurate VAT accounting, but also for maximising your VAT recovery position. So understanding where you are potentially underclaiming VAT, as well as when you're potentially at risk of overclaiming VAT. So on this first slide, we've just entered some pretty high level points as a bit of a tick list of conditions really that need to be met to enable VAT recovery on costs that are incurred in the business. So I'm just going to work through these just in order in a little bit more detail, starting with that first one, taxable person. So in short, a business can only recover VAT if it's VAT registered or it is required to be VAT registered. So if it's exceeded the threshold, for example. So without VAT registration, there is no entitlement for the business to recover VAT on its costs. Important to remember on this point that just because a business doesn't trade in excess of the VAT registration threshold, that doesn't necessarily mean that it's not able to voluntarily register for VAT. That is an option as long as the business makes taxable supplies or it has an intention to make taxable supplies. And sometimes that is a beneficial move for certain businesses if a lot of its costs are VAT bearing. The second one, and this is one that often we see gets overlooked, unfortunately, but the VAT must be correctly charged by the supplier before it can be recovered by the buyer or by the customer. So like I say, this is sometimes overlooked, and a lot of businesses maybe don't appreciate that HMRC's view is that as the recipient of the supply, it is your responsibility to ensure that the VAT has been correctly charged on an invoice or on a supply by your supplier before you recover it as VAT. We often see that where that step is overlooked, retrospective action has to be taken as a result of the VAT being charged incorrectly. So if the if the supplier has charged VAT when it shouldn't have, or if it's charged VAT at 20% rather than 5%, for example, HMRC are within their rights to disallow that VAT, even if the supplier has paid it from their end. So that can often involve you as the recipient having to go back to the supplier for a refund, for a credit note, etc. And that can often be quite a difficult position to navigate, especially if the VAT is disallowed by HMRC several months or potentially several years after the invoice has been received, because there's always the risk of not being able to contact that supplier any longer, or the supplier potentially being out of business. So that's a very, very important point to cover off when receiving VAT invoices. And on the VAT invoice point, it is always necessary that adequate support and documentation is held to support the VAT recovery. So the gold standard in terms of evidence for VAT recovery is always going to be a valid VAT invoice. And I'll touch on in a few moments what a valid VAT invoice should look like. What information it should include. There are certain scenarios where HMRC may allow alternative evidence to be provided to support recovery in the absence of a VAT invoice. But from our own personal experience, both within Safri and within working for HMRC, the cases where HMRC would allow that evidence are quite limited. So we'd always recommend that steps are taken to ensure that a valid VAT invoice is held before making a claim for VAT. The next one sounds fairly obvious. So you must be the recipient of the supply in order to recover the VAT that's been incurred. So HMRC will always take the view that only the person to whom the supply is made for the use in the furtherance of their taxable business can make a VAT recovery claim, or a valid VAT recovery claim. That recipient point overrides the question of who may have paid for the supply. It also overrides the question of who may hold the relevant invoice. Like I say, that sounds fairly obvious, but we do see instances where company A is supplying company B with services, for example, but company C agrees to cover the cost. So we see instances quite often where the invoice might be made out to company C in error, or company C, because it pays the VAT, pays the invoice on company B's behalf, then believes it has an entitlement to that VAT recovery, which isn't the case. It's only the true recipient of the supply that has that entitlement. And then the final 2 points then, I suppose, go quite hand in hand. So only costs that are directly and wholly attributable to the making of taxable supplies are recoverable. So HMRC would expect the business to be able to evidence how any purchase is attributable to the making of taxable supplies. So that is any supply that is subject to 20%, 5%, or 0% VAT. Where that is the case, and all of the other conditions above that I've already mentioned are met, then the VAT is going to be fully recoverable. There is an added layer of complexity if the business is partially exempt. So if it makes taxable supplies and exempt supplies, for example, because naturally some costs within that kind of business, such as your general overheads, your accountancy fees, etc., are going to relate partly to the taxable supplies of the business and partly to the exempt supplies. So in those cases, there is an additional step to the VAT recovery process whereby the VAT is still recoverable, subject to the other conditions being met, but only in part, and the part of the VAT that is recoverable would be determined by the business's partial exemption calculation. So just to quickly recap on that point, then, just on the next slide, please, Nick. The conditions that I've just outlined on that previous slide must all be met for the VAT incurred on any purchase to be recoverable. Where any of those conditions are not met, so for example, if you are VAT registered, if the supplier has charged VAT incorrectly, if you're not the recipient of the goods or services, if you don't hold a valid VAT invoice, or if the costs relate to anything that is not a taxable business activity, then should HMRC ever open up a review or an inspection, and they review that invoice or lack of, then you can expect HMRC challenge, and then you've potentially got an assessment for that over recovery of VAT, which unfortunately then can lead to further interest and further penalties being chargeable. So very, very important that before making a claim for VAT, that you do check that all those conditions are met. Just on to some popular misconceptions now, that we see quite often really within our advisory work. Some of these can lead to VAT being overclaimed, but in other cases they can also lead to VAT being underclaimed as well, where businesses maybe don't fully appreciate the VAT recovery provisions and the opportunities that are open to them in terms of VAT recovery. So just on that first point, I suppose I've touched on this a little already, but it's quite a common misconception that simply paying for an invoice gives that business that has made the payment the right to recover the VAT. As we already know from the conditions I've just outlined, the VAT recovery is not automatic just because a payment has been made. All of those other conditions must also be met. One of the important ones being that you have to be the recipient of the supply. Any of those conditions are not met, just because a payment has been made doesn't then mean that you have an entitlement to VAT recovery. Reverse charge VAT. So when the reverse charge applies, so this will typically be the case where services are purchased from overseas suppliers, for example. The overseas supplier shouldn't be charging the business with overseas VAT. So if it was a French supplier, for example, you wouldn't expect to see the French supplier charge you with French VAT. However, the reverse charge would apply, which would mean that as the customer, you would self-account for the VAT by declaring the output tax or sales VAT. That would apply if the sale was made in the UK, so typically 20%. So you would bring that VAT to account on the business's VAT return. And the input tax then, so the purchase VAT, can then be recovered subject to the usual conditions that we've already touched on, all being met. So that often looks like just a kind of an automatic wash through, if you like. So the VAT goes in and goes out on the same return. But it's really important to remember that VAT is only recoverable, not automatically, but only where the usual conditions are all met, in exactly the same way as if you were to make the purchase from a UK supplier. So you'd expect those conditions to apply. If the supply related partly to exempt activities, or if it related partly to non-business activities, then you would still restrict the amount of VAT or the amount of reverse charge VAT, that you would be entitled to recover. And then these next two bullet points then are more, I suppose, are more opportunities rather than risk areas. So we often find that we have clients and businesses that don't appreciate that VAT can actually be recovered on costs that are incurred in the setting up of the business, so prior to the business making taxable supplies. So HMRC will allow VAT recovery, provided there is a clear intention to make taxable supplies in the future, and the costs incurred relate to that future taxable activity. So that can include things like pre-trading expenditure, professional fees, setup costs, marketing, advertising, initial stock purchases, so on and so forth. So the timing of that first taxable sale is not in itself what determines the entitlement. It is the intention behind the purchase. So we'll see in certain businesses, forestry activities is a good one that, HMRC accept that you're going to have to incur VAT bearing costs many months, sometimes many years in advance of any taxable sale being made. That doesn't then mean that you're not entitled to that VAT recovery, as long as that intention is genuine. And that intention to make taxable supplies in the future can be evidenced, then subject to the other conditions being met, that VAT is still recoverable. And then the final one then, and this is one we probably advise on more than any other really, popular misconception that the VAT can't be reclaimed on costs incurred before the effective date of a business's VAT registration. So HMRC does actually allow businesses to reclaim VAT on certain pre-registration costs. The rule for goods and services is slightly different in terms of the timing. For goods, you can actually go back as far as 4 years from the effective date of registration, which seems like a really long time. So it can be quite an opportunity from a VAT recovery perspective. The conditions for purchases of goods are that you must still have the goods on hand at the time of your registration, and you must be able to evidence how those goods are then used to make future taxable supplies. So that's quite a handy provision to use when it comes to non-consumable goods that have been purchased before VAT registration, if you like. So things like business assets that are purchased within that that 4-year period prior to registration. There is potential for VAT recovery on those. For services, the rules are slightly different. So we can only go back 6 months prior to registration, provided those services relate to the business activities, the taxable business activities, I should say, that are carried out after registration. So those claims must still all meet the normal conditions that we've already covered. But I would definitely recommend that for anyone that has registered within the last 3 to 4 years, or anyone that's maybe about to register or is considering registering in the near future, we'd recommend considering their position when it comes to those pre-registration costs. It's often an exercise that we carry out for our clients just prior to registration to determine, okay, what's the most cost effective date for registration, and then what's the 4-year rule and the 6-month rule for goods and services purchased before registration mean for your VAT recovery position. What is a VAT invoice? So I thought I would just touch on this just very lightly, given that holding a valid VAT invoice is one of the most important conditions for ensuring that you're correctly recovering VAT. I just thought I'd list out here the information that HMRC would expect to see on an invoice from a supplier in order for it to be a valid VAT invoice. So essentially, if any of this information is missing from a supplier's invoice, it's not going to be classed as valid by HMRC. So if ever HMRC came to review it for whatever reason, they would have the discretion and the power to disallow the VAT recovery should the invoice not hold any of this information. So very important that checks are done when those VAT invoices are received from suppliers. And I'd highly recommend that if at any point a VAT invoice isn't provided, or if an invoice is provided which doesn't contain all this information, then the first step should be to go back to the supplier for a corrected copy as soon as is possible, really. I touched earlier on HMRC potentially allowing alternative evidence in the absence of a VAT invoice, but from experience, we would only really be able to go down that route where the business has clear evidence that it's not been possible to obtain a valid VAT invoice, from the supplier. Only then would HMRC potentially consider going down the alternative evidence route. I should touch on here that a full VAT invoice is not required if the supply value is £250 or less. So for supplies of that nature, HMRC does allow what they call simplified VAT invoices to be used. So for those such invoices, it wouldn't require all of the information on this slide, just those that are highlighted in bold, as well as the total amount payable, the VAT payable, and each VAT rate that applies to the goods or services supplied on that simplified invoice. So that will likely be the case if you are making smaller purchases from retailers. Things like fuel receipts, etc., should normally qualify as simplified VAT invoices, but we'd always recommend you double check it. And then for anybody that is potentially billing under a self-billing arrangement, again, I would just ensure that the same care is taken to ensure that the invoice you're issuing on the supplier's behalf still includes all of that. all of that information to make it a valid VAT invoice. And then final slide from me. So we've called them pitfalls, so non-deductible costs, if you like. So regardless of the conditions that we've touched on already, there will be certain costs that are quite common within a lot of our businesses that are just not recoverable. So the first one that we've listed here is business entertainment. So this will basically be hospitality of any kind, really, that's provided to anyone that is not an employee. Typical costs, things like taking clients out for meals or drinks, taking them out for events, providing them with hospitality packages, etc. Even where there's an argument to say that the purpose of that expenditure is to maintain relationships, win new client business, the VAT on those such costs is not recoverable because it's blocked under those business entertainment rules. Staff entertainment is treated slightly differently and can be recoverable, but only where that expenditure is generally for staff reward or staff motivation, but is not mixed with client entertainment or prospective client entertainment. Car purchases. So the VAT on the purchase of the outright purchase of a car is going to be blocked in most cases. The only way that VAT would be recoverable, is if the car was used exclusively for business purposes and it's not made available for private use at all. And that second point there, we typically find that HMRC sets a very high bar in terms of evidence in that a car is not available for private use. And their position basically is that even if a car has minimal private availability, it would be blocked. The VAT would be blocked from recovery. For lease cars, on that last point, the scope for VAT recovery slightly improved. So where a business leases a car, the VAT recovery is restricted by 50%. So that is to account for the assumed private use of the car by the employee or the director. If the business is partially exempt, for example, then again that cost should be treated as a residual cost. So that 50% would be further restricted via the partial exemption calculation. Over to you, Mick.
Thanks, Owen, very much. Good morning, everyone. So Owen's gone through some of the fundamentals there of VAT recovery, and to go back to the kind of subject matter that we're covering today, at the heart of mastering VAT recovery is understanding those fundamentals. So when a business is considering whether or not VAT on a cost is recoverable or not, do go back to those fundamentals. They are your starting point in that deliberation. Just to finish off that little section on what you can't recover, just a slide here on just some common things that we see that aren't correct when we're working with clients. So there's some common costs that business often gets wrong in terms of VAT recovery. So just rattle through these. Train fare and airfare, no VAT recovery on those because there is no VAT to recover. You're not being charged VAT. These supplies to you are subject to 0% VAT, so there is no VAT to reclaim. So please resist the temptation to book some VAT recovery on those types of costs. Similarly, taxi fares. The issue with taxi fares is that the supporting receipt you get from the driver is a little bit of scribble on a card and is falling rather short of what would be accepted as valid evidence to support your VAT recovery. So generally steer clear of the temptation to recover VAT on taxi fares and online purchases. So if you're buying, buying items, let's say off Amazon and other similar platforms, the evidence you get is again, you're very, very unlikely not to get a VAT invoice. You'll get an order confirmation, you'll get an email. It's not clear whether or not, if it's not Amazon that sold you that item, it's a merchant operating off Amazon, you're not clear of if that party's VAT registered even. So there might be the opportunity to tick a box to say, please send me a VAT invoice. Do look out for those, but otherwise online purchases often do not result in you having adequate evidence. And as Owen has mentioned, retention of a VAT invoice is always your starting point there, and it's HMRC's go-to as well for when they're reviewing your VAT recovery. And on that, just final point on non-deductibles and common issues, these are things that HMRC will certainly look at as part of inspections and assurance events. They are trained to hunt out business entertainment. They are trained to look for car purchases. We know this because Owen and I have been HMRC officers in our former lives at some point. And so when we did that job, we were on the hunt for business entertainment costs and purchases of cars that hadn't been treated correctly. And we commonly saw VAT recovery on 0 rated costs. Okay, so talking about opportunities and risks, and perhaps I should have called this slide processes and controls as the main header, because I'm going to think about how effective processes and controls can enable opportunity for VAT recovery, to maximize VAT recovery, but also can help mitigate and manage risk of errors arising in the processes which result in VAT ultimately hitting the VAT return as recoverable. Rather helpfully, in September 2024, HMRC released some guidelines for compliance, GFC 8, which dealt with general VAT compliance, providing HMRC's view and expectation of business of what their processes and controls should look like in order to manage their VAT compliance affairs effectively and in a manner consistent with responsible taxpayers. Those guidelines were not specifically related to VAT recovery, solely related to VAT recovery. But they did contain several chapters which relate to the recovery of input tax and the processes and controls that HMRC would expect businesses to adopt to ensure the VAT recovery position is correct. So do check those out. They are a very helpful tool for understanding what HMRC's expectation is. What kind of processes and controls are we talking about when we're thinking about VAT recovery? Obviously, VAT recovery comes from costs that business is incurring. And in many cases, it's necessary for a business to go through this process called attribution. Some of you may be familiar with that term, particularly applicable if you are a partially exempt business. So if you have taxable and exempt suppliers, or if you have non-business activities, let's say you're required to adopt a process by which when a cost arrives, when a cost lands with you, is making a decision of what that cost relates to. Because when you book it into your account, you should be doing so in such a manner that it's being identified correctly. So it either hits the VAT return as recoverable, the VAT isn't analysed as recoverable and is posted to the P&L, or it sits in this kind of bucket of costs which are going to go through to your partial exemption calculation. So your residual costs or your items that go into the pot, as you might be more familiar with that term. So attribution is the decision that you make when a cost lands with you, when an invoice is being posted. Well, what do I do with this? How do I treat the VAT on that invoice? What does the cost that I'm incurring relate to? And going back to some of the fundamentals that I mentioned, a cost that's wholly related to an exempt supply is typically not going to be recoverable. So, what kind of process do you have internally as a business to enable the individuals that are making those decisions, that are posting costs, dealing with the invoices coming in? What kind of training have they had, and what's the process that they adopt? Do they have sufficient information available to them and resource available to make the right decisions, or do they know where to ask in the organisation how that particular cost should be dealt with? Tax codes is very helpful. So many accounting software packages will have tax codes in them, so you can assign a tax code to a cost when you're posting it. And they're very helpful for putting costs into the right bucket when they're being posted. So we typically see codes being used for recoverable VAT, irrecoverable VAT, the residual VAT, the non-attributable that will be subject to partial exemption, etc. So, but do be mindful of tax codes. You can I mean, many systems will have default tax codes within them. Are they? And if you choose to use the default tax codes, are they doing what you think they should be doing, what they're intended to do when you post something using that particular tax code when you post a cost? So do be mindful of that and do some testing. Also, if you're using kind of bespoke tax codes, again, make sure that it is ultimately doing what you intended to do in terms of where it's posting that cost, how it's treating the VAT, whether it's recoverable, irrecoverable, or what have you. And then what training are you giving your teams? Do they have enough knowledge, enough at their disposal to be able to make the right decisions with respect to tax codes? Okay, so I've identified this cost as relating to an exempt supply. We're not going to recover this VAT. Which tax code am I required to use here to ensure that that VAT doesn't slip through into the recoverable total? Going back to VAT invoices again, they're touched upon this. So VAT invoices being received that don't have the right kind of information on them, either they're not valid VAT invoices for one reason or another, or they don't contain the correct or sufficient details to identify you as the customer with the entitlement to recover. So we often see invoices being received with incomplete or incorrect customer details on. So the name isn't the full name, the address isn't included at all, etc. So it is a requirement that the full customer details are on the VAT invoice. And obviously, as the customer looking to reclaim the VAT, you need to be able to provide your vendor with the details that they should be including on their invoices in terms of the customer name, the business name, company name, the name of the partnership, the name of the trust, whatever it happens to be. But they get that right, and they have enough information from you when you're instructing them to provide the goods or services that you're asking them to, that they have those details. So there aren't any issues with having to go back and seek corrected invoices or new invoices, because that's not always very straightforward to do. The other point that you can think about from processes controls is how can the payment sign-off process internally help to inform the team who is posting invoices. Often the budget holders and the people signing off the costs won't necessarily sit in finance, they will be outside finance. So, you know, what is the process by which they can inform the finance team of what the cost relates to exactly. So that should be a pretty clear, well-defined process, ideally. So the right decisions are being made by the right people when those costs are being booked. So with respect to processes and controls, always a good idea to dust those off from time to time, have a look at them with a fresh set of eyes and try and spot any weaknesses within them and correct those accordingly. When can you claim VAT? So you can claim VAT in the VAT accounting period in which the VAT is chargeable. Obviously, you're not charging the VAT. The vendor, the supplier, is charging the VAT. So when in the period when it's correct that they've charged VAT, and it's typically the time of supply, the tax point, that's the period in which you can reclaim the VAT as the recipient on the basis that you have the adequate evidence in your possession, i.e. typically the VAT invoice. If you don't have the VAT invoice at that point, then it might be that you are having to chase the supplier up for a copy of it. So that's typically when VAT can be reclaimed. But do be mindful of late claims. So there are some circumstances where you've received an invoice. Ideally, you'd want to be booking that VAT as recoverable if it is in the VAT accounting period in which the invoice is received, but it might be received quite late in the period after you've already closed your monthly books and your monthly reporting is done. That costs may be getting held up in internal approval processes. Some things might be being verified with the supplier. There might be a query on the invoice. So in some circumstances, the VAT may get claimed in a later period. HMRC are generally okay with that, but they are getting a little bit tighter and stricter around late claims where something hasn't been claimed. There's no real reason why it wasn't claimed in a particular period. It just didn't happen to hit the VAT return. might be the temptation to say, we'll just stick it into the next return. It doesn't really matter. We were the ones losing out because we haven't claimed it when we should have done. But HMRC are a little bit tighter on this, and they would expect disclosures to be made if that hasn't been claimed in the appropriate period when everything otherwise would have enabled you to reclaim that VAT. And the critical point there is, if you are claiming VAT in a later VAT return period than would otherwise or should otherwise have been the case, then do be mindful of what your recovery in the period in which you should have reclaimed it was. If you're subject to partial exemption or a non-business apportionment or anything like that, you have to revert back to what the recovery position in that period would have been, and not in the period in which you're actually claiming the VAT. So do be careful of those types of points. I'm going to just crank up the complexity a little bit we just call them deal fees. So costs associated or costs incurred with the acquisition of a company or the disposal of a company. So we just like to badge them as deal fees. And in particular, an in particular complex area is the VAT position, the VAT recovery position for holding companies. Holding companies don't always undertake business activities in their own right. So the concept of economic activity here is very important. So economic activity, essentially the same as business activity. So going back to a fundamental of VAT recovery, costs must be incurred with respect to a business activity in the first instance. Holding companies don't always have economic activities. They don't always undertake such activities. The holding of shares for investment purposes and just to receive dividends isn't an economic activity. That's settled case law that's the case. So if you've got a passive holding company, its VAT recovery is extremely limited, if not zero, because it's got no economic activity. When we're looking at deal fees and VAT recovery on deal fees, we break it down different positions for the buy side if you're buying a company, a different position if you're selling a company. If you're buying a company, is the VAT on the legal and professional fees that you incur, is that recoverable? That comes down to who is incurring the cost, and are those costs relating to an economic activity or an extension of the existing business that's made the acquisition. In acquisition structures, we typically see a holding company inserted, and the holding company starts to incur these legal and professional fees. So great care must be taken that you don't end up with an unexpected or a VAT cost at the end of this that hasn't been budgeted for. So there are steps that can be taken to ensure that VAT on those costs is recoverable, but the planning and the advice around that needs to be really done as early in the process as possible, and ideally even before you've really started down the road of that acquisition in earnest, because there are certain things that it's very helpful to have documented in meeting minutes and in etc., to demonstrate what the intention is with regarding this acquisition. So yeah, if you're buying a company, very important that early advice is taken on that, because you may end up with a situation where VAT recovery isn't possible, and that's not what you would expect. And HMRC will have a good look at legal and professional fees, because errors are often found for those types of cost. Similarly, on the sell side, so if you're selling a company, the legal and professional fees you incur will have VAT on, and can you recover that VAT? So often the party selling the shares is an individual shareholder, and you know, an individual person or persons that hold shares in a company that are selling those shares. Obviously, they're typically not taxable persons in their own right, certainly not that capacity. And so, you know, an individual shareholder on that basis won't have VAT recovery entitlement. So someone, you know, the VAT's going to have to be paid for, but it's not recoverable on those costs. If it's a company that's making the disposal, so a holding company selling its subsidiary, be mindful of the fact that a sale of shares, of company shares, because that is what is happening when you sell a sub, it's a VAT exempt supply. And obviously going back to the fundamentals which Owen described, that is typically not recoverable where it's incurred in respect of making a VAT exempt supply. So there's an obvious issue there. That brings me nicely onto the recent Supreme Court decision in Hotel Latour. I think it's fair to say that when that case, the appellant lost at the Supreme Court, having won at first tier and upper tier. It lost the Court of Appeal, and it lost at the Supreme Court. If it had won, if Hotel Latour had won at Supreme Court, we'd probably have dedicated this entire webinar to that decision, because it would have had pretty far-reaching implications and consequences around the principles of VAT recovery. It would have changed perhaps some of those fundamentals that we talked about at the start of this presentation. But it lost. So we're only going to spend a few minutes on it. What was Hotel Latour about? It was a holding company selling a subsidiary. It was selling its subsidiary for the purpose of raising funds to finance a future taxable activity. The holding company was going to develop and operate a new hotel. So to raise money to do that, it sold a subsidiary that it owned that had a hotel and operated a hotel. So it sold that subsidiary. Going back to that earlier point, sale of shares is VAT exempt. So Hotel Latour, the holding company, made a VAT exempt disposal of shares. So on that basis, you would have expected the VAT to not be recoverable, and ultimately that's what the Supreme Court has decided. The appellant's argument throughout this was that the costs should be attributable to the downstream taxable activity that was intended. The only reason that they were selling the subsidiary was to raise funds to finance those activities. So that was the argument, and they tried to kind of persuade the court that what we believed was settled EU case law, going back many years, was now kind of out of date and had been superseded by other decisions. But the Supreme Court held firm on this and concluded that you can't look through in that way. You can't look downstream to the intended activities that would be funded by this disposal. The VAT exempt disposal of shares has kind of broken the chain, if you like, and you can't look beyond that. So that VAT isn't recoverable. That's not to say that there isn't VAT that's incurred in the sale process at some point. It might be that earlier sort of DD costs or general preparation for putting the sub into a position to make it attractive, more attractive to potential investors. There might have been some general kind of business costs incurred in that process. So there might well have been some recoverable VAT in there, but that's early advice is absolutely essential to making sure that those types of service are quickly identified and you're able to capture those and deal with those effectively. Doing well for time. Let's move on to the final slide. Just going into beyond the basics a little bit. On that point, and we start with specified supplies order on that point of an exempt sale of shares not yielding or not entitling the supplier to VAT recovery entitlement on leaving professional fees. The position in Hotel Latour would have been different if those shares had been sold to a non-UK party. There would have been then the opportunity under the specified supplies order, which is a very specific piece of VAT legislation, might have enabled Hotel Latour to recover that VAT or part of it. The specified supplies order generally should be of interest to those operating in the financial services and insurance sectors. And where your customers, and if you're operating in those sectors, where your customers are based outside the UK. So it's a very specific set of circumstances, very specific types of supply that it provides an opportunity for, but it is an absolute opportunity that otherwise, what would otherwise be irrecoverable VAT on costs for those supplies being made domestically, for certain financial services, which would include the sale of shares, for certain financial services and certain insurance services supplied to non-UK parties under the SSO, the supplier has some VAT recovery entitlement. So it's entirely feasible that an operator in that sector could be VAT registered purely to recover VAT under the SSO, because otherwise all of its supplies are exempt or outside the scope with the right of recovery. So I've worked with businesses that are VAT registered purely for VAT recovery opportunities that are provided by the SSO. We've touched upon partial exemption. We've mentioned it several times. It's a key concept in VAT recovery. We could probably do 2 or 3 webinars purely on partial exemption. At its heart, it's a relatively straightforward concept for those businesses that have taxable and exempt supplies. Get full recovery on costs with respect to your taxable supplies, restricted recovery on your costs which relate to your exempt supplies, and then you have the non-attributable and overhead costs that sit in the pot in the middle. So partial exemption is essentially how much of that residual VAT can you reclaim. It sounds very straightforward when I say it like that, but it is a rather complex mechanism when you get into the real detail. It's around attribution, around the method that you'll use. As a standard method, you're required to default to unless you agree a special method with HMRC. There are complexities around things that you include in the standard method and things you can exclude. The standard method being an output-based apportionment method. Complexity around whether you have a non-business apportionment before your partial exemption. There's complexity around the de minimis limits. Some of the simplifications that the partial exemption system affords. So be aware, if you've got exempt supplies, if you've got taxable supplies, you are partially exempt and you will be required to undertake specific processes and calculations to determine exactly how much VAT you can recover. Capital goods scheme is I don't like the word scheme in that, to be honest. It's kind of slightly misleading. It's more of a mechanism that you're required to monitor the use of certain capital assets. So where VAT bearing capital expenditure exceeds 250k on the land and property CGS assets, that will increase at some point in the near future. The government has announced that limit will be increased to 600k, but that hasn't happened yet. And you're required to basically monitor the use of the asset over a period of time, typically 10 years for land and property assets. And if there's been a change of use between taxable, exempt, non-business, business, you're required to make an adjustment to your original VAT recovery when you incurred the costs on that capital expenditure. CGS can be quite complex. It can be often overlooked, missed. Businesses don't realize they have a CGS asset in some cases, and then start making decisions about using that asset in a different way and give themselves an issue because they're not aware. So absolutely be mindful of the fact that certain capital expenditure will create capital goods scheme assets that require you to monitor the use of that asset over an extended period of time. Owen's already dealt with pre-registration VAT. Just to touch on that, HMRC, it is a discretionary point. The law provides HMRC with discretion whether to allow pre-registration VAT or not. Generally, we don't see an issue with it. Generally are successful at helping clients secure pre-registration VAT. There was some specific guidance for independent schools when they were having to register because of the change to the VAT treatment of private school fees. So there's some specifics around that, some rather interesting guidance from HMRC on the pre-registration position for schools. But it is discretionary, so just be mindful of that. That whilst we see generally HMRC accept it, it is that they do have the power to reject. And then finally, change of intention. So Owen mentioned one of the popular misconceptions is that you can only start recovering VAT when you're making a supply. That's not the case. You can recover VAT based on intention. I intend to use these costs to make taxable supplies in the future, and you evidence that, etc. Equally, I'm not recovering this VAT because I intend to make exempt supplies of these costs in the future. A change of intention before you've actually made those supplies will result in either clawback or payback. So clawback is where you have recovered VAT with the intention of making your taxable supply. You then change your intention before you made that supply, and you go on to use those costs to make an exempt supply. And in which case, the VAT that you've claimed is due back to HMRC. Payback is the opposite, where you've had the intention to make an exempt supply, not recovered, but subsequently changed your intention before making that exempt supply, going to make a taxable supply, and therefore that VAT becomes recoverable. Interesting thing about clawback and payback is the time limits. You actually have 6 years from the point that from the change of intention, rather than 4 years. You'll be aware that 4 years is the statutory error correction time limit for VAT. But for clawback and payback, for the change of intention rules, there's a 6-year period. So yeah, do bear those in mind. There's some interesting process, particularly around payback. You're supposed to ask for HMRC's permission to adopt payback, which can be rather time consuming to obtain. So that brings us to the close of the presentation. I hope you found this helpful. Just to recap, I'm Nick Hart, VAT partner based in our Bristol office. Owen Hackling is VAT manager, also based in our Bristol office. So thank you, Owen, for helping today. I think we've got time for some questions.
Yeah,
I haven't been keeping an eye on the Q&A window, unfortunately, but there, Amy, I think you've been tracking those coming in.
I have, yeah, we do have a couple of questions, so I think we do have time for those now, so that's great. And I think obviously a really interesting presentation. It does seem that in a lot of cases, going back to the basics is sometimes the key to spotting some of these common issues. Just before we move to the questions, I was just going to ask you though, of all the things you mentioned, because you're both advising clients on this every single day, are there any areas in particular that HMRC are focusing on, or of the ones you mentioned, sort of more than others?
I think whenever they know the business is partially exempt, they will get into the detail of whether the business is doing partial exemption properly, whether it's using the standard method properly, whether it's attributing the costs properly. So that's always a focus for HMRC when they know that there's exempt suppliers. I mean, Owen can speak to. As I said, we talked about some of the common non-deductibles that HMRC will look for, but I think partial exemption is a big one because it is quite complex and business often doesn't get it quite right.
Yeah. Okay. Just conscious of time, I want to get through the questions that were submitted. The first one was, is VAT recoverable on advice leading to a disposal? So, for example, due diligence work. I think you did mention this at a high level, Nick, but just to sort of answer the question properly, do you want to take that one?
Yeah, it can be. I think if you can demonstrate that the services are being supplied to a taxable party, the trading company, effectively, and if a disposal, if you do a DD, you assess sort of the condition, you assess if there's any kind of inherent risks being carried along. You have an idea of then what kind of issues might arise with a DD from the buyer a bit further down. So it puts you in. You have knowledge about risks that you might be carrying that need to be addressed. And if you don't go down the acquisition route, you can still use that knowledge to refine things that you do within that business to deal with some risk, to address areas that are potentially not being handled correctly, and therefore you can point to a kind of, well, this cost is more of a general, it's for general use, if you like. It's for business strategy. It's for developing the business. So it's not necessarily a cost that's wholly attributable to the ultimate disposal. So it's an interesting point. It needs to be looked at on a case by case basis, and it needs to be, the right things need to be put in place at start of the process, not later on, because it's much more difficult to kind of have a supportable position once certain services have already been provided.
Okay, thank you. The other question we had, can VAT be reclaimed 50% on lease and 100% on maintenance on cars leased under the EV salary sacrifice scheme?
Oh, do you want to say that? You've touched on lease cars.
Yeah. So can you say that again, Amy? So you've got
Yeah.
a lease car.
It says, can VAT be reclaimed 50% on lease and 100% on maintenance on cars leased under the EV salary sacrifice scheme?
Yes, I believe that would be the case. So as long as the car, if the lease of the vehicle is made by the agreement for the lease was made by with the business, the taxable business, and that is a fully taxable business. So there's no exempt activity within that business. Then yes, the 50% block would apply to the VAT recovery on the lease payments. The maintenance then, I might need to double check with you now. I believe the maintenance cost can be fully recovered, Nick.
Yeah. Subject, your overall VAT recovery position.
Yeah, but again, going back to as long as the business is fully taxable, if it was partially exempt, you'd be looking at partial recoverability, subject to the partial exemption calculation.
Yeah.
I think that the point around the 50% block is that it is the block that effectively deals with the private use risk or the availability of a lease vehicle for private use. And private use could be as straightforward as the journey from home to work. That is a private journey, and that is private use. And if the vehicle isn't a genuine pool car, so kept at the business premises and the use of it, it's controlled, etc., then it's available for private use. And the 50% block on the lease deals with that private use issue, whereas on the purchase of a car made available for private use is basically you're blocked on all of the VAT on the purchase. But obviously for leases you don't own the vehicle, and so to deal with the private use element, we have this 50% block. But the maintenance isn't subject to the same block.
Yeah. Thank you both. We had one final question submitted, which I think we've got time for. We are charged VAT by non-UK suppliers and not currently reclaiming this. Is there a way the VAT could be claimed back?
I think Owen mentioned that we typically don't expect to see overseas suppliers charging local VAT to UK businesses. I mean, there are some circumstances where they do, and it is correct that they do. I think on the whole, for services, we would expect it not, but there are some services where we would expect it. So if you've correctly incurred overseas VAT, and it's always a good idea maybe to push back on the supplier and say, do you know that you're supplying a UK business? But if it's right that they've charged local VAT, that VAT's not recoverable through a UK VAT return. That's the starting point. You can't recover that VAT through your UK VAT reporting. There is an opportunity potentially, certainly in EU member states, there's an opportunity for us to go to them and apply for a VAT refund through a specific non-resident VAT refund scheme. So you might some might be familiar with the 8th directive claims or 13th directive claims. So that's where UK businesses can go to an EU member state and seek to reclaim VAT incurred in that member state. Again, and it's recoverable subject to local conditions, local VAT recovery rules, and that the VAT has been incurred in respect of a taxable business activity being undertaken by the UK company. So there's opportunities, but it's not recoverable through a UK VAT return.
Okay, brilliant. Thank you very much. Thanks everyone for submitting questions if you did. And as I mentioned, you'll all get an email with a link to the recording. We have got previous webinars on the website if you wanted to go back and look at those. There's one on employment taxes and one on corporate taxes. And before we go, just a big thank you to Nick and Owen, and a big thank you to all of you for attending. And I hope you can join us for the next one. Goodbye from us.